Good morning, everybody. It is Friday, February 25th, a couple days after the Russian invasion of Ukraine began. And I'm not trying to be insensitive here, but as you saw, I wrote an article saying that the Ukrainian tragedy, which is what it is, won't matter to stocks or really even the economy much a month from now. And there's a number of reasons for that. One of them is that the Ukrainian economy is very small compared to just about anything in the developed world. And one of the statistics I put in here is that including their black market, the Ukrainian economy is about $200 billion. Of course, the United States economy is about 24 trillion. And just the Fed balance sheet has expanded by 4.5 trillion in the last couple of years. So Ukraine is tiny. That doesn't diminish that what little Vladdy Putin is doing isn't horrible, but in the grand scheme of things, it's not going to impact things too terribly much economically unless the Western powers make a mistake on how they handle things, which is not beyond them. But so far, it looks like they're targeting the individuals in Ukraine. It looks like they're targeting the individuals in Russia and the banks in Russia that have to do with the military or giving the orders, and not targeting the energy or the broader economy of Russia. And that's probably smart, because why would you want there suddenly to be more sympathy for Putin among the Russian people who, according to most reports, already doubt him at multiple levels? So when we take a look at this, it's a blip, and it accelerated a decline in the markets that I've been forecasting for months. I said that 2022 would be a lot like 2018. I also said that about 2020, and I probably would have been right if not for the pandemic and the QE infinity. So now, 2 years later, we're in a situation where valuations are still very high, but the rolling corrections that started a year ago have already done a lot of the damage to the markets, a lot of the correction to the markets and the stocks within the market that needed to happen. So as I've said a number of times, when the large caps and mega caps finally correct, that means the correction is almost over, not just beginning. Because of course the small caps have already corrected, and many of the mid caps, particularly the COVID rebound stocks, the meme stocks, have already corrected. We took a look at PayPal and Square a couple of weeks ago, complete round trips. Square had earnings yesterday that were pretty good. And I think a lot of people are seeing what I'm seeing with that company, which is just a lot of upside over time. And soon enough, they'll see it with PayPal as well. Square, I think, was up 20% today. Now, granted, that's after a 60% decline. So they only got a little bit of it back, maybe a fifth. A lot of room to the upside on Square and PayPal. If you sold puts on those a couple of weeks ago when I suggested it, looks like we were just about perfect on that trade. So if you are a option seller, you may want to subscribe, because these option trades have really been working out pretty well. You know, the exception has been the small caps, and we own a lot of small caps right now. But what did we see yesterday after about 11 in the morning? Small caps rallied. And now we're starting to see institutional investors get into the small caps. So once the float on a lot of these small cap stocks tighten up, because institutions are buying the shares, it's going to be very hard for short sellers to push them down anymore. And with margin rates going up just a little bit, that'll make it harder too. So I think you can see a lot of short squeezes in the small caps. I think you can see just general accumulation over a period of time. And as earnings demonstrate that these companies are executing, sentiment for the stock becomes stronger. There's a saying that earnings drive stock performance, and it is absolutely true. However, I have talked about time lags. Sentiment doesn't catch up with earnings usually on the way up, and sentiment usually leads, however, on the way down. So when things are negative on the earnings side, stock market gets crazy hateful very quick. But when earnings start to go up, there's that lack of belief. Oh, I don't know, they just had a rough patch. I'm going to remember the rough patch rather than seeing how good things are getting. And it takes a long time for positive sentiment to get there. But once it's there and the momentum begins, then you get the spikes. So the emotions of the market, the madness of crowds certainly correlate to the fundamental realities, but with the typical time lags and necessary periods it takes for people to believe in a positive story, whereas we're all too willing to believe a negative story. That's why, even though the world has gotten demonstrably better decade over decade over decade for centuries, we see what's right in front of our face that's negative. We miss the forest for the tree that we're about to run into. The world just keeps getting better. Higher literacy, better health, less poverty, less war. Even in the face of what's going on right now, there's fewer troops deployed today in the world than there ever has been, or at least since the world wars. So in the last 120 years or so. I used to have that statistic tied to our very short list. I'll do another article about why everything is actually getting better. The reason we think it's getting worse, we're experiencing it right now, is that of the things that sell, sex probably being number one, but fear is number two. So the media, and I don't just mean your big media, I mean pretty much all media, sells bad things. They sell the negative because it generates an emotional response, which generates revenue. So whether your negative response is just keep clicking on the bad story articles and then to get grumpy about it, and then you buy a gun or you buy a generator, or you just keep on clicking ads and you buy deeper and deeper into a negative narrative. Click, 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 click. Everyone's worth something. Every click is worth something. So that is probably one of the negative things about technology, is that getting a negative narrative out there is very, very easy. And because we're emotional creatures, we buy into it. So I would encourage you to always look on the bright side of life. For those of you who are movie buffs, I'm sure some of you know what that is. All right. So what's going to go on with stocks here? Well, it looks to me like 2018 scenario is in fact playing out. And something to keep in mind is that the negative narrative out there about inflation that I've been telling you is just a negative narrative is starting to play out the way I said that it would play out. The inflation number today came in lower, still hot, but lower, less hot than a couple weeks ago. And there is this idea that somehow the Fed is going to be the one to contain inflation. And everybody's pounding on the Fed, raise rates, roll money off the balance sheet. These are traders trying to get the Fed to make a mistake because they can make money on it. It's all the chanters about, it's the same group of people. The chant about the dollar's going to collapse and gold's going to the moon and everything else. These Austrian economists that I warn you about, they don't just believe in market cycles. The traders within the group try to influence the market cycles. Oh, it's going to go this way. Oh, it's going to go this way. And here's why, and here's why, and here's why. You know what I have to say about that. Bullshit. There's some very easy things that we can look at now that will tell us what exactly the Fed is going to do. And the answer is, unless there's something very out of the ordinary, the Fed is not going to raise rates anywhere near what people are thinking. The thing that will lower inflation is not the Fed. It's a little bit more oil temporarily. That's it. That's all it'll take. How do I know? Here's how I know. Here's your consumer price index. Jumped up to 7.5%. Very scary, very scary. But here is the 5-year forward inflation expectation. 5 years from now, nobody expects inflation to be really anything more than 2%, 2.1%, 1.8%, but right around 2%. That's what that says. For a hot minute, expectations were 2.4% 5 years from October. So why, in the face of this, aren't the 5-year forward expectations much higher? And in fact, trending down since fall, even though inflation has gone up since fall. Why is that? How can that be? Well, it's because everybody knows this: slow growth forever. The velocity of money is what really drives inflation. So when you have a lot of money in the economy, which we do, if it's not changing hands very often, right, there's no demand push, inflation can't really stay high. And that's why I said a while back, the year-over-year comps starting late in summer, early autumn, it's going to be almost impossible for those to show inflationary pressure. because price levels pretty much across the board are going to be the same or a little bit lower on some of the big ticket items like oil or housing, maybe food. Hard to know if food will be a little bit more expensive or about the same or a little bit less in the fall. Weather, things like that. We do know that potash prices probably go up just a bit. Why? Because one of the biggest potash producers in the world is in Ukraine. So we'll see if anything gets disrupted there. But here, this is the velocity of money. Just keeps coming down and down and down. Let's take a look at inflation. Down and stayed down, got lower, stayed lower. And now we have this spike from the pandemic. It's the only thing that's different here, right? This big downward trend over a very long period of time. Then we get a spike. This was the housing spike. This is the rebound from the pandemic spike. Disrupted supply chains, second biggest thing. But the biggest thing that's keeping inflation up is price of food and energy. So this is what the CPI would be minus food and energy, right? Right there, 3.9%. So I've told you that X energy inflation is about half. There you go, 3.9 from 7.5, about half. Let's take a look at this one. How do I know that oil is the most important thing? Look at that. The red line is crude oil prices. The blue line is inflation. And this is lagged this is the 5-year forward. Are they not almost identical? Huge correlation, oil prices to expected inflation. And I showed the current real-time one too, where it just trailed a little bit. And in fact, the lag from oil prices going up or down to inflation going up or down is pretty much exactly 1 year. Why? Because the year-over-year comps, which is how the formula is figured out. They use price increase year over year. So here is the sticky inflation minus shelter. Again, 4.3%. So what you just saw there is that minus energy, food, and shelter, inflation is in fact about 2%. There's very little going up in price other than what's impacted by energy, food, and shelter. Even the labor shortage hasn't really impacted prices that much. It might in the future a little bit, but it hasn't yet. So what do we know about housing? We know that housing starts to be going up and up and up and up and up and up. And in fact, projected, we're going to hit the record again late this year, early next year for housing coming onto the market. What happened the last time housing starts and housing completions got very high, right? Had a prolonged period of housing prices going down. And housing prices took 3 years, 4 years, about 4 years to bottom during the financial crisis. Peaked in 2007, end of 2006 actually, came all the way down, then jitterbugged around the bottom 2009 to 2011, 12. And didn't really start going up until 2012 because prices follow this line. So as supply gets higher, what happens? Demand goes down. There are some challenges, but consider this. Even as housing starts and completions go up, that's despite all these things. So what happens if interest rates don't go up much, but the price of oil comes down and lowers inflation? And the 1 year, year-over-year comps start to hit late summer, early autumn. The Fed's probably raised interest rates a point by then, and they start to see that inflation's going away. Are they going to keep raising rates at that point? No, because they're going to take a look at growth rates. And they know that as one of the biggest drivers in the economy, housing, that as housing construction peaks, they can't get too tight because they'll cause another rout. So I'll tell you right now, all these people talking about the Fed's going to raise their rates 7 times this year and 5 more next year, and they're going to roll money off their balance sheet and really tighten things up. I redirect you to this chart. The economy has already slowed down. If you take a look at the GDP prints, the only way that the Fed has to raise rates more than a point or a point and a half, which is really just to reload their bazooka, is if something really out of the ordinary happens, which probably would have to be more war to drive inflation up. And that's not going to happen. If you're paying attention to what's going on with Russia and Ukraine, you know that China is involved. They're the ones that cut the deal with Russia a month ago to buy natural gas, which essentially enabled Russia to go into Ukraine with almost no consequences despite the sanctions because they have a buyer for their gas. They didn't care that the pipeline was going to get shut down. They knew the United States wasn't going to allow it or was going to fight it at least. So they sold the gas to China. Done deal. Putin was nice enough not to invade until the Olympics were over Good for him. And now China is trying to look good by publicly making this call to Putin and saying, hey, why don't you get to the negotiating table? If you're not seeing all the theater and pre-planning of all of this, that's exactly what they want. They want you to be confused. They want you to be emotional. It's the same thing when you go into a store and they have the end caps and they have those Cheetos that you really like. Just trying to create an emotional response, keep you off balance. Maybe you do something that makes them money or gives them what they want. What Putin wanted, if you any of you are a subscriber to Foreign Affairs, I pretty much read like 50 articles on it in the last month. What Putin wants is actually what he's saying. He wants Ukraine to be demilitarized, and he wants a bigger buffer. He wants more secure access to the Black Sea, and he doesn't want the Ukraine in NATO. And how does this all play against what I said the last 2 weeks when I solved the whole thing in 1 minute? He would prefer that Ukraine remain a neutral state. He'd prefer it be part of Russia, but a neutral state is the other solution. Don't be surprised if that's what comes out of this, because we're never, ever letting them into NATO to begin with. It's been 8 years. We haven't let them in. The Ukraine's going to end up being a mutual buffer. And if they play their cards right, they'll get really rich doing it. It's an educated population. It's in a good geographic spot, right? I mean, for multiple reasons, not just being on the Black Sea, but between two forces, two powers that need to interact, but are mutually afraid of each other. I think a lot of people in the West don't understand that, truthfully, Russia is afraid of being invaded. It's happened to them before, several times. It's not an irrational fear on their part. And we have the biggest military in the world, and we keep getting inches and inches closer to them over time. Try to put your feet into their shoes. So this is all going to resolve. Ukraine is not going to cause a bunch of inflation. And because of that, oil is the main thing that we have to watch out for. And what announcement did we just get today? The one that I said would happen a week ago, 2 weeks ago. President Biden said he's going to pump more money out of the Strategic Petroleum Reserve. And the next thing that you're going to hear is there's a deal to refill SPR. Exxon and Chevron already have said they're going to increase their production 800,000 barrels a day by about this time next year. Somebody asked, why do I think Putin won't claim Ukraine as part of Russia versus keeping it as a buffer country? Well, basically, that would be a declaration of war. That's number one. And number two, it would be incredibly hard for him to keep control of Ukraine. Incredibly hard. He'd have to occupy it. Crazy expensive. And it makes him very vulnerable because a lot of his troops would be in one place. That's easy for us to attack if it came down to that. If we wanted to get into end of the world stuff. It makes sense, and things that make sense usually happen, for Putin to bomb the military bases and then cut a deal. He's already threatened to overthrow the government. So that's his card, right? Fine, I won't overthrow the government, but this is what I need. Now, he might be nuts. We'll see. I don't think he's nuts. I think he's just a greedy, power-hungry bastard. But again, the shadow of enemies at the door, real or imagined, is a powerful thing. So don't think that the United States and the Western allies haven't screwed up here. They've been screwing up for a long time in Eastern Europe, particularly with Ukraine. You would have thought that the people who advocated for Ukraine to be a neutral state over a decade ago would have been listened to, because it's not a new idea. It might just be part of the whole, we do things wrong until we do them right? That old Churchill thing about America, right? You can count on the Americans to do things right after they've tried everything else. Maybe that's just part of this process. Hard to know. But how does it impact economics? Again, it doesn't really matter very much. What matters is that slow growth forever is still the story. The Fed knows it. So the only way that the Fed raises interest rates a lot is if they feel like they've been forced into it by inflation. Inflation probably starts going down of its own volition by around Labor Day. That'll be the end of the driving season. There'll be more oil having come online. By the way, there's probably going to be an Iran deal that gets more oil online. So if inflation is mostly about oil, that's probably going to work out at the end of the driving season with a combination of more oil supply and a little bit less demand, seasonally speaking. And we already know that long-term oil demand growth has fallen to below 1%, has for about a decade. The rebound off of the pandemic isn't your rate. Your rate is, you smooth it out over 5 years or 10 years. And with EV adoption, having growth rates, granted off of a small number, but the growth rate for EVs is well over 20%, and I think it's going to accelerate significantly if they ever pass Build Back Better, which I think they will. It's just going to be a budget neutral plan, which is the smart thing to do. If you're going to raise X amount of dollars, why would you spend it all? Why wouldn't you let the residual effects of the growing economy actually reduce the budget deficit 5, 6, 7, 8 years out when we get the peak boomer debt? Peak boomer debt and obligation is the end of this decade. Once we get past that, U.S. debt's going to slowly get repaid over 30 years, and the dollar is going to get stronger. And during the 30s, during the millennial economic boom, right, they're kind of entering it now. They're in like batting practice. The 30s are going to be monumentally good for the United States from a standard of living standpoint. Who knows how the stock market reacts, but economically, the 2030s just look spectacular. So don't expect a lot of interest rate increases because oil is going to cause inflation to go down. Housing is going to cause inflation to go down. Supply chains adjusting are going to cause inflation to go down. The main one being semiconductors. I did talk about that in this article. You should read this article. This is not my most popular article, so I didn't give 10 dividend stocks or talk about option trading. But this is probably a more important article than any of those from a macro standpoint for sure. You ought to be taking a look at these right now. 2 or 3 months from now, you're going to go, gosh darn, I missed the bottom. You're bottom ticking these media companies right now. 5 years into the future, you're going to go, wow, I wish I had bought that one 400% ago, or that one 500% ago, or that one 300% ago. My top 10 dividend stocks obviously got a ton of attention. So just to rehash, the break-even interest rate, which forecasts future inflation, is about 2% on the 30-year and the 10-year, which is weird. But this is what you really want to watch short term. And this is, again, why the Fed won't raise rates much. Make this one a little better. The Fed's not going to raise interest rates much because they don't want to cause a recession unless they have to. Chairman Powell's very keen on that. So this is the spread between 10 years and 2 years. It's narrowing. Every time it flattens or gets negative, you see a gray line. That's a recession. 100% correlation. He needs to keep this line from going down much further, or we'll get a recession. And he for sure doesn't want a recession before the inflation is over. So I do not expect a 0.5 point increase in March. And I think that the Fed funds rate does not get higher than 1.5%, and it might not get higher than 1%. And the Fed has $1 trillion on its balance sheet sitting there available, or actually not on its balance sheet yet, but it's available by law through the Treasury, $1 trillion to support the repo market. And in September of 2019, when they did it, stocks started going back up. So while I expected a correction, and I think under normal circumstances, we would see a very 2018-like year this year with a bigger correction at the end of the year. If the Fed starts bailing out the repo market this year, say in autumn, stocks probably start going up, and we will get valuations that don't come down as much as they should have. So we'll see. They're trying to navigate this, but it's going to be difficult. This right here does not leave them a lot of wiggle room. We need to fight inflation with more oil supply. I know the greenies hate that. I don't like it either. But at this point, we've done so much damage, and we just have to wait for things to work out over time. So somebody asks, you mentioned that we'll get another buying opportunity in Q4, but you said buy a little bit yesterday. Yeah, we got a pretty good correction. We're probably going to get a bear market rally at some point. You need to be willing to trade things every 3 to 6 months if you're going to play the bigger parts of the cycle. If you just want to buy and hold forever, I'm sorry to disappoint you, but that only works during Fed-driven bull markets. It's never worked at any other point in history. You can see 5 and 10-year periods all the time where stocks don't go up. There's like 7 of them since the Great Depression. So when people say buy and hold, I think you can say that about just a handful of stocks, a few of them on my list, but you have to react to what's going on. And this correction just accelerated. And this is telling us that the Fed's not going to raise all that much. So does the market have a deeper correction in the fourth quarter? Like I think we'll see. I just told you what could prevent that. And what could prevent that is if the Fed starts doing QE again before the end of the year. Will they? I don't know. Maybe just having $1 trillion to bail out the repo market keeps the repo market from getting screwed up again. But maybe they have to use the money and start pumping it in. If they start doing QE again before the end of the year, right, that money seeps into the stock market after a little bit of a delay. If I had to guess, I'd say the repo market does not get screwed up and they don't do QE this year. But if the economy slows down more than I expect, they will do the QE because the banks will feel that pressure and they'll have to put that money into the repo market. Anybody who tells you they know what's going to happen is a bullshitter. You know, when somebody brags about their education, I was the top of my class at this college and, you know, I've seen more than you. And just because I talk about Elliott Wave or this other thing, I know all the other stuff better than you too. And I know more than the generals about war. And I know more about the businesses of other people's companies and the CEOs, right? Anytime you hear stuff like that, just call bullshit. There's always more than one scenario that can play out. And we're just trying to assign probabilities so that we know how to react when things become more apparent and are happening. So we will see. But you need to embrace slow growth forever. I talk to you about it all the time. I get tired of pounding it in. But the boomers are causing low velocity of money. And that's going to start turning up over time as the millennials continue to replace the boomers in the economy. So we're probably we've probably seen the bottom in the velocity of money during the pandemic. And it should rise to about this level soon during the next expansion. Now, will it get way up here again? I don't know. But somewhere in here is where it's likely to get to by the 2030s. So we just, next 9 years, it'll get there somehow. Some jitterbugging pattern, but the general trend will be up. And that's why I'm pretty darn bullish longer term. I think coming out of this year, things are going to look pretty cool. And I guess another reason, if you're a conspiracy theory person, a reason why the Fed would do a little bit of QE around Labor Day would be the elections, right? I mean, Powell's a Republican, but he works for the president now. So if Powell starts using that QE money because he needs it for the repo market, or just because, we'll see. We'll see what happens after Labor Day. Between now and then, there's probably going to be a little rally. So if you're heavy cash, you don't want to wait 6 or 9 months to buy more stuff, 9 more months, I think you can buy a little bit of QQQ. Yesterday, if you had bought when I said to buy, and granted, I understand that it's hard to know exactly when, but if you were watching the news over the weekend, you knew the market was going to open up really low if there was an invasion. Got the invasion, the market was at limit down. So these are some tradable occurrences. When you take a look at QQQ, it intraday changes to the 4-hour chart. It actually hit right on my line. Look at that. It hit right on my line that I have had there for months. And all those stocks that are at bottom fishing prices right now, that a year ago, people said there's no way it can drop that low ever again. Look, the way I do forecasting, I stole it from some really good people. I've made some very minor improvements. It's pretty good. And that's why I position trade mostly and don't swing trade a lot. I do make a handful of those 3 to 6 month trades though. So I'll shooter thrives in that week to week environment. I'm more of a quarter to quarter and year to year guy. So when all this stuff was up here and everybody was trying to navigate the day to day moves and week to week moves, I just said, well, it's going to get down here again. So I'll just look at it when it gets down here. It won't get back down there again. That's, there. Now it looks a little bit more impressive, right? So we're getting this rally. If you want to trade it week to week, go work with shooter. But I think we probably get past the red line, back up into the upper 300s, and then it comes back down. And how far into the buy zone it gets, it all depends on if this becomes a problem. Do we start seeing recessionary pressures? And I don't think so, because I think the Fed knows, where is it? The Fed knows inflation is tied to oil more than anything else. The Fed did not create this inflation, and that's the thing that you got to get out of your head is that they did. The Fed did not cause this inflation. OPEC manipulating the price of oil and busted supply chains did, and a little bit of lack of housing. And the lack of housing, I'll tell you what, the regulators, the politicians are starting to figure this other one out too. They figured it out in Las Vegas, so they'll figure it out in other places. You're going to figure it out in Puerto Rico too. The short-term rental market has been very bad for people looking for a place to live. And the regulation and the taxes on Airbnb related stuff and the other short-term rental places, but Airbnb being the biggest one, are going to go up. There's going to be more regulation and more taxation for people who have more than one or two Airbnbs. For people who just keep on buying properties and making them into Airbnbs, it's going to become harder and harder for them. It's not a great business model. You're better off buying out a hotel that has fallen into disrepair and then fixing it up, making it a little bit nicer than buying 4 or 5 single families or condos. I guarantee you that I'm right about that, which is why I don't look in that market, which is why I'm looking to develop something bigger. And, you know, you've seen that I want to buy truck stops. You've seen that I want to buy hotels. They're cheap. They're in good spots usually. You don't have to run around to different properties for management purposes. So as Airbnb regulations get tighter and taxes go up, and that'll loosen up inflation too, because more of these houses will just go back onto the regular rental market. And then another thing to keep in mind is that something like 20% of the houses in big cities in the last 4 or 5 years have been bought by institutional investors, building pools of houses in cities like Phoenix and Vegas, Los Angeles, San Francisco, New York, and that never ends well. The last time that happened was right before the financial crisis. They've taken it to an art form this time. So what happens when the government starts saying, you know what, you're a primary cause of the rent is too damn high, and we're going to regulate and tax you for this too? It's going to happen. It's already happening. So inflation is really just truly not that big of a problem. It is transitory. In that article I wrote in the fall, I said it would start to go away in a year. Everybody said, a year? A whole year? Well, such is life, man. I don't write the rules. Tell you how to read them. So this is how inflation has looked since World War II. Almost none, then a step up, and then a step up. And it was on that plateau for a long time. And now we jumped it up on rallies and hype. It crashed. QE to keep it up. Crash. QE to keep it up. Crash. QE to keep it up. What is that all about? Why are they so desperate to keep it up here and not have deflation? It's because deflation leads to depressions. So this is the new area. And it's going to drift up with the millennials. As the boomers become less of the economy and the millennials become more, it'll drift up. And the Fed won't even have to do much. Just have to get out of the way. So Tom Lee, I think, is right. I think after this valuation correction is over with, whether it's all done in this year or it takes several times for it to happen, stock market will eventually be priced about right. But you do just have to be selective, right? You've seen the round trips. Last week, we went through the round trips. There's a ton of stocks out there that you can buy right now, a ton of them. It's just hard to buy ETFs and indexes because you don't want everything. But if you're selective, I mean, the best investors out there are building 20 and 30 stock portfolios. And I'm telling you, you need to do the same thing. And you can pick things out. So the stocks of the week that I'll put together this weekend, I've decided on even better formats. So stocks of the week will be very comprehensive, but then the retirement income options is just going to be the option trades. So the retirement income options article would be pretty much straight to the point. And then for research, you go to stocks of the week or the individual articles. All right. What kind of questions here? Yeah. Somebody makes a point about investors that are getting into pilots and flying J's and other truck stops. Right. Mike points out that deflation makes debt more expensive. Exactly. So one of the biggest points I put in this article was that the Fed, right here, the Fed wants real interest rates to stay near zero, regardless of what the bankers want or what Wall Street pundits and tweeters who chant want. They need to keep the real interest rate near zero. Why? Because we have a lot of debt. If the real interest rate isn't at zero, we're not paying any interest because inflation offsets it. So when they target 2% inflation, what they're really telling you is at 2% inflation and 2% interest rates, which is where we're at, the government is financing the economy for nothing. I spent yesterday with Dom. I'm a little bit sore. We went and visited great grandma, took her a burger and a shake, and 94-year-old great grandma, burger and a shake, and she walked around her apartment without her walker yesterday. It scared the hell out of me. Then we went to the museum and we went to a mall. Yeah, a mall. It was pretty much empty. The mall was open till 8 o'clock at night. Most of the stores were closed at 7. That was kind of funny. So we just drove around a little car stroller for an hour. But yeah, good day. And I would encourage you to look at those good day things more than you look at the negative news, because the world is getting better. And once we get through this valuation correction, however it plays out, good things, best companies are going to do really well. We have a bunch of them in our stable, and the economy is just going to get better and better and better for the next 20 years. Like I said, we have a little bit of a speed bump to get through at the end of the decade, but I think they pulled forward a lot of that relief already. And I think that you should really be looking at the bright side of life, because it's going to be pretty bright. Have a great weekend.